Stocks and the stock market for beginners. In this course, I'm going to take you from the very basics of what is a stock, what are dividends, and why companies have stock in the first place. And then by the end of this presentation, we're going to cover how to find good investments yourself, how to read financial statements yourself. It's really not that complicated if we start with the basics. You can do it. And how to pay as few taxes as possible legally on our stock market gains. So this course is perfect for anyone with beginner or intermediate knowledge of investing. Basically, if you're not an investment banker at Goldman Sachs yourself, I guarantee you will learn something new. And hey, if you don't learn something new, I will introduce you to my 100% money back guarantee. But good luck with that, because this entire course is 100% free. This whole project is actually a bit of an experiment, and you are my test subject. So YouTubers are generally opposed to creating very in-depth, nitty-gritty content for free for two major reasons. First, they make more money selling it. I estimate I'm giving up about $90,000 by posting this for free. But most importantly, number two, people don't care. Most popular creators on YouTube feel people simply don't care about information unless they're paying for it. That's how you actually get someone's attention. So I'm going to pay really close attention to what the average watch time is on this course to test and see if YouTubers' assumptions are right. Do people care? So if you watch this for only a minute or two and then turn it off, I'll know that people indeed don't care unless they pay for content, and I'll have the answer to this grand experiment of mine. To help solidify the content, I have built a quiz that accompanies this entire presentation to test how much you've actually retained from it, because what's important is how much you actually retain and you can take with you to the real world. So this quiz is built to be taken at the end, but you can do so alongside the presentation if you like an open book test. Whatever you want to do, whatever's the easiest way for you to learn, I'm totally open to it. I am really excited for you. I'm excited for you to watch this presentation and hear the feedback, because I spent around 50 dedicated hours putting this together in the most simple, coherent way possible. I don't think that there's anything else like this. And I even went so far as building all of the charts and drawing all of the illustrations in this entire presentation myself. So I'm pretty excited about this. So grab some free stocks. Also, before we get started, there are various offers linked down in the description for free stocks with Webull, Robinhood, and M1 Finance. Feel free to utilize those if you like. And if you do so, those companies will send me a free stock too as a thank you for sending you their way. Without further ado, let's get into it. And here we are, Stock Markets for Beginners, a free course for Neanderthals. If you aren't sure of who Neanderthals are, who is the Neanderthal? That's you. You are the Neanderthal, by yours truly, Max Maher. All right, I'm going to start off with some intros here and some definitions to cover our bases before we get in real deep. We want to make sure you understand everything before we get in deep. And we're going to start off real simply here. What is a stock? A stock, also known as a share, those words can be exchanged for one another, stock and share, represents a small piece of ownership in a corporation. Your total ownership is also referred to as your equity in a company, your equity share, your equity stake in a company. So here on the left, I have a diagram of a pie. We typically represent the shares of a company as a pie. In this case, there's only 4 shares. Each share is worth 25% of the company. And then on the right here, we have a pie with a few more slices. I believe there's 14 slices there. And each of those 14 shares are worth 7.14% of that company. Now, most public companies have millions, if not billions of shares. So you don't own anywhere near 7% of a company by holding 1 share in normal circumstances. But you can see all that needs to happen is that pie needs to be split up into more and more fractions to create more shares of a stock. Moving on from here, you are an owner when you buy a share of a company, when you buy a stock of a company. So buying a share or stock in a company means you actually own that slice of the business, believe it or not. Buying 1 share of Coca-Cola, for example, means you are actually an owner of Coca-Cola. Doesn't mean you can go in there and start bossing people around, but you actually own a small little slice of Coca-Cola. And this is actually the right fraction. If you own 1 share, you own 0.232% of Coca-Cola if you buy 1 share. Now, what it means to own a share of a company. Owning a share or the stock of a company entitles you to a portion of that company's assets and profits, and also voting rights depending on the kind of share that you bought. But we're going to talk about that in a couple minutes here, the different kinds of stock that you can buy. But doing some definitions, assets are a resource with economic value, which basically means it's worth money. An asset is a resource worth money that the company owns either because it's valuable in and of itself, something like cash, and or helps produce value like a piece of equipment. A tractor or a conveyor belt is worth money, and it also helps produce money. Those are both considered assets of the company. And you also are entitled to profits when you own a share of a company, and profits are the financial benefit that a company gets to keep after deducting expenses from revenue. So total sales minus total expenses equals your profit, equals the company's profit. Now that doesn't exactly mean that is all going to be paid out to shareholders, because some of the profits get reinvested back into the business. Only a small portion, in only some cases, gets paid out as a dividend, which we'll explain all of that a little bit later. Not all shares are created equal though. Share price means nothing without additional context to that share price. So repeat after me, share price means nothing without additional context, but that doesn't quite flow as well. So if company A's shares cost $10 and company B's shares cost $100, that does not necessarily mean that company A is cheaper than company B. This is a very common misconception, and you do not want to think that way. And that is because of market cap. Market cap is the total value of a company. In order to calculate market cap, you take the total number of shares, the total number of slices in that pie, and you multiply that by the share price, and you get the total market value of that company. So here's some examples, and this will highlight the share price discrepancy that I was talking about a second ago. So Coca-Cola, they have 4.3 billion shares. The current price is about $54 a share, which means their market cap is $232 billion. 4.3 billion times $54, $232 billion. Then we have GameStop, whose share price is actually higher than Coca-Cola by more than 4x. It's $217 per share, but the total market cap is $15.3 billion, far lower market cap, but that's because they have far fewer shares. So market cap is really what you want to look at when determining how expensive a company is, not share price. You need to know share price and total shares to understand how expensive a company is. And also here's a note down here, a stock split increases the number of shares. So sometimes you'll hear about like Apple did a 4-to-1 stock split. It means that each share of that company is now split into 4 shares, and the value is also divided by 4. So if the share was $100 and there was a 4-to-1 stock split, that means you now own 4 shares worth $25 each. A reverse stock split is the opposite of that. So 4 shares to 1 share, for example. This does not change the value of the company. This does not mean the company is now cheaper, but companies do this because people tend to think that the company is now more affordable because the share price is lower. This is not the case. Do not fall into that trap. Moving on from here. Oh, it's all about the shares times the price, baby. I forgot that I wrote that there. Anyways, why do companies have stocks? Why do they have them? They have them to finance growth and the expansion of their company by giving up some of their ownership and some of their profits. So they sell off some of their ownership and some of the rights to their profits in order to expand the company, if there are profits. A lot of times there aren't profits quite yet when a company IPOs. It all depends on the individual situation. We'll define IPO in a minute here. So here's an example. And yes, I drew all of this. I did all the illustrations myself here. So Nice Buns and Company. Let's say you own 100% of this bakery, but you want to expand. You don't want to necessarily take out a loan. You want to sell a portion of your business in order to expand. This is what you can do. You decide you want to sell 25% of your company to finance that second location. So in order to do that, you sell 10 shares of your company to 10 investors for $20,000 each share. And this is the result of what happens after doing that sale. Each investor now owns 2.5% of your bakery. And by owning 2.5%, they are now entitled to 2.5% of the profits paid out to owners, and they own 2.5% of the assets. That doesn't mean that they can just go and sell 2.5% of the assets. They can sell their shares to someone else, but they own 2.5%. And the sale also means that you raise $200,000 to finance the second location corporation of your bakery, Nice Buns & Co. And that means that you now own 75% of the company instead of the 100% because you sold 25% of your company. And this actually means that your bakery now has a market cap of $800,000. And remember, we get this by taking the total shares, which is 40 in this case. You sold 10 of the shares, but there are 40 total in the company, times the value of each share, which is $20,000. And that's how we get a total market cap of $800,000 for Nice Buns and Company. Moving on from here, what if you wanted to sell shares in the open market? What if you wanted to take Nice Buns and Company public? This is when a company IPOs, which is called the initial public offering. This is where a private company goes through all the regulatory and the underwriting process that allows them to then sell the shares of their company, if you wanted to sell that 25%, on the open market to the general public, to anyone. You and I could buy shares of Nice Buns & Co. So Nice Buns & Co. probably wouldn't be able to go public though, because they're simply not large enough, because this is very expensive to do, and there are pretty hefty requirements to do so on most exchanges. But that is what it means when a company IPOs and anyone is now able to buy a small portion of that firm. Congratulations, you have completed part 1 of stock markets for beginners. I can feel you already getting a little bit smarter, piece by piece, a little bit more knowledgeable about all things stock market. So join us in part 2, where we're going to talk about the various types of stock, what the stock market is, what stock brokerages are, and the various stock market sectors. You don't want to miss this next section. Also, make sure you like part 1 and subscribe to this channel for future updates on all things stock market and finance news. See you in the next section.